Hello everyone and welcome to this explainer. To all the Indian tax aspirants, CA students, tax professionals, and commerce students tuning in today, we have a really fantastic and highly focused session lined up for you. We are going to absolutely master Section 18 of the Income Tax Act. You know, if you've ever stared at the statute and wondered how on earth to make sense of the dense legal text surrounding profits in lieu of salary, well, you are exactly in the right place. We're going to break down every single provision, clause, and subclause into clear, logical, bite-sized pieces. So let's dive right in.
I want to start by throwing a quick question your way. Imagine a company pays you before you even join them. Maybe they offer you a golden handshake or a massive sign-on bonus. Is that taxable as salary? I mean, think about it. Technically, the employer-employee relationship hasn't even started yet on day zero, right? You might think this is a pretty clever loophole. Well, spoiler alert, the tax department thought of this too. They realized they needed a massive catch-all net to make sure that any financial receipt connected to your employment, completely regardless of when it's paid, gets taxed under the head of salary. And that is the exact problem our topic today solves.
So, let's get the core definition down. Profits in lieu of salary is a specific statutory provision designed to guarantee that various financial receipts tied to your employment are taxed exactly like your regular monthly salary. The phrase literally means in place of salary. And the legislative intent here, it's actually super intuitive. It's there to prevent tax evasion through disguised payments. Think about it. If employers could just rename a chunk of your salary as a special settlement or a joining fee so you wouldn't have to pay tax on it, the whole system would just fall apart. So Section 19 steps in and says, look, no matter what creative name you give it, if it's tied to the job, we are taxing it.
Okay, to make sure we cover every single statutory reference today, here is our roadmap. We'll start with decoding profits in lieu, then we'll map out the employment life cycle, dive into provident funds and insurance, carefully look at statutory exclusions, and wrap it all up with a rapid exam revision.
Let's kick things off with Section 1, Decoding Profits in Lieu, and why I like to call it the catch-all net. At its core, Section 18.1 is an expanding provision. What it does is artificially stretch the standard dictionary definition of the word salary to capture things you just wouldn't normally think of as a monthly wage. We're talking pre-joining bonuses, termination settlements, and payouts from special funds. The law is basically casting this giant net over any monetary benefit that is directly tied to the employer-employee relationship. It's their way of making absolutely sure nothing slips through the cracks.
Moving right along to Section 2, the employment life cycle, which covers Section 18.1a and b. Now, memorizing statutory clauses can get a bit dry, I know, but if you map them onto a timeline of your career, everything just clicks. Every career has distinct phases, right? You have month 0, before you've even started. Then, let's say around year 2, maybe your employment contract gets modified. At year 5, perhaps there's a termination of employment. And finally, year 6, post-cessation, where you might still receive some sort of settlement. Well, Section 18 maps perfectly onto this timeline. Let's break down exactly which clause gets triggered at which phase of your career.
First up, let's look at the outer edges of our timeline, pre-joining and post-employment. This is governed by Section 18.1b. This clause states that any amount due to or received, whether that's in a lump sum or otherwise, by an SSE from any person is taxable if it happens before joining any employment or after the cessation of employment. Now, here's what's really fascinating about this statutory wording. It explicitly says from any person, not just your employer. Why do you think that is? Well, it's because before you join, they aren't technically your employer yet. And after you leave, they're a former employer. So if you get a massive joining bonus before day 1, or maybe a delayed non-compete payout a whole year after you quit, Section 18.1b pulls it right back into your taxable salary.
Okay, moving into the middle of the timeline, we have Section 18.11a. This clause taxes the amount of any compensation due to or received by an assessee from their employer or former employer in 2 very specific scenarios. Scenario 1, at or in connection with the termination of employment. Think of your standard severance packages or compensation for early termination. Scenario 2, at or in connection with the modification of the terms and conditions relating to employment. Imagine your employer suddenly changes your working hours to something completely unfavorable, or they take away a specific perk and they pay you a lump sum to compensate for that detrimental change in your contract. Well, under Section 18.11a, that compensation doesn't escape. It is purely taxable as profits in lieu of salary.
Let's transition to Section 3, Provident Funds and Insurance.
This brings us to Section 1811C. For everyone preparing for exams, please pay very close attention here. This is a notoriously tricky area.
Before we get into the weeds with specific funds, we absolutely have to acknowledge the general rule under Section 1811C1. This subclause simply states that any payment due to or received by an assessee from an employer or a former employer falls under profits in lieu of salary. It's a massive, sweeping inclusion. Basically, if your boss hands you a financial payment that isn't standard salary, isn't a perquisite, and isn't specifically exempt, this subclause catches it. It sets the baseline before the statute drills down into more complex financial instruments.
Building right on top of that general rule, Section 1811CCII deals specifically with provident funds. And I want you to notice the strict dichotomy here. When you receive a payment from a provident or other fund, the entire amount is not taxed as profits in lieu of salary. The statute explicitly says it is taxable to the extent to which it does not consist of contributions by the assessee or interest on such contributions. What does that mean in plain English? It means your own contributions to the fund and the interest earned on your own contributions are totally excluded from Section 18. What actually gets trapped and taxed here is the employer's contribution and the interest on the employer's portion. Memorize this distinction. It is an absolute pillar of taxation when it comes to retirement benefits.
And rounding out Section 1811C is subclause III, which deals with key man insurance. If you're not familiar, a key man insurance policy is essentially a life insurance policy that a company takes out on a vital employee, someone whose sudden loss would cause massive financial strain to the business. The law states that any sum received under a key man insurance policy, as defined in Schedule 2, Note 1, is taxable right here. But wait, here is the critical exam tip. The statute explicitly states this includes the sum allocated by way of bonus on such a policy. Seriously, don't let a tricky exam question bait you into exempting the bonus portion. If the money is from a key man policy, the principal and the bonus are fully taxable as profits in lieu of salary.
All right, let's pivot to Section 4, Statutory Exclusions under Section 18.2. Any seasoned tax professional will tell you that while the general rules set the stage, the exclusions are where the real traps lie. Section 18.2 is what we call a saving clause. It provides specific statutory relief from those incredibly wide taxing provisions we just discussed. It literally pulls specific items right out of the broad reach of Section 1811C. If a payment falls under subsection 2, it is legally and safely removed from being classified as a profit in lieu of salary.
Now here's the catch. Section 18.2 doesn't just write out nice, neat descriptions for you. It uses specific statutory cross-references that you simply need to know. It strictly excludes any payment referred to in Schedule 2, Table Serial Numbers 3, 4, and 8. It also excludes Schedule 3, Table Serial Number 11. Now, obviously, we are focusing purely on the text of Section 18 today, but as a practitioner, you really should know that these references point to very specific terminal benefits, things like certain gratuities, commuted pensions, and recognized provident fund balances, all of which have their own separate exemption mechanisms under Section 10. But for the strict purpose of Section 18, just remember this. If it matches these specific Schedule 2 or Schedule 3 serial numbers, it is absolutely 100% excluded from being a profit in lieu of salary.
We have covered a lot of really dense statutory ground today, so let's bring it all together with Section 5, Rapid Exam Revision.
Let's fire through your taxable inclusions all in one place. Under 1811B, we catch the amounts before you join and after you leave. Under 1811A, we catch termination settlements and compensation for modifying your contract terms. And under 1811C, we catch any general employer payment, the employer's portion of provident funds, and key man insurance payouts, heavily noting, of course, that this absolutely includes the bonus. If you can just visualize this list, you've completely conquered the inclusions of Section 18.
Next up, let's reinforce those critical exclusions. From the Provident Fund Clause itself, 18(1)CCII, we exclude the assessee's own contributions and the interest on those contributions. Then, strictly under subsection 2 clauses A, B, C, and D, we exclude the specified items from Schedule 2, that's serial numbers 3, 4, and 8, and Schedule 3, serial number 11. I promise you, identifying these correctly on an exam, or in practical compliance for that matter, will absolutely secure your marks and keep your clients fully compliant.
So what does this all mean? To wrap things up, Section 18 guarantees that the inherent nature of a receipt, the undeniable fact that it's born from an employment relationship, is what truly determines its taxability. It's not just about the timing of when the cash hits your bank account. Whether it's month 0 or year 6, If it's tied to the job, the tax department is watching. So the real question is, how will you apply this logic the very next time you look at a complex compensation package? Thank you so much for joining me on this explainer. Keep studying smart, and I'll see you in the next one.